Welcome to The Explainer, where we break down complex topics into clear, understandable explainers. Today, we're going to peel back the curtain on the U.S. tax and immigration systems to reveal the powerful mechanics that operate just beneath the surface. Okay, let's dive into this. First up, let's challenge a common assumption about entering the U.S. This belief that as long as your entry is legal, the method itself doesn't really matter. As it turns out, the way you enter can have massive and often totally invisible consequences down the line. Now, what's really interesting here is the critical difference in legal protections. When you use the Visa Waiver Program, it's convenient, sure, but you agree to forfeit your right to see an immigration judge if any issues come up. And this single, often overlooked detail means that for VWP entrants who overstay, the path to removal can be incredibly swift and without appeal. The system's logic has also expanded in other non-obvious ways. You see, visa officers can now use non-contagious health conditions, things like diabetes or obesity, as a basis for denial, all based on the potential future cost to the state. Okay, let's switch over to the tax system, where another surface-level belief that all income is taxed the same hides a really powerful truth about how things are structured. The key to all of this lies in understanding a specific business structure called a pass-through entity. For a lot of business owners, this is the number that really matters: a flat 15.3% self-employment tax on every single dollar of profit. It's for Social Security and Medicare. But by structuring as an S-corporation, owners can legally recharacterize their income using a simple two-step process. And this just illustrates the crucial point perfectly. The income you take as a distribution completely bypasses that 15.3% tax, creating some pretty significant savings. Now, let's look at one of the most counterintuitive yet incredibly powerful mechanisms in the tax code, the concept of a paper loss. This sounds impossible, I know, but it's actually a foundational principle for many savvy investors, particularly when it comes to real estate. The answer is a concept called depreciation. It's a deduction the government provides as an incentive to supply housing. So by combining three specific things, a short-term rental, a study to accelerate that depreciation, and meeting certain participation rules, investors can generate these large paper losses that can then offset their primary job income. So the crucial point across all these examples is that navigating these complex systems isn't about finding secret loopholes. It's about understanding the mechanics, the cause and effect relationships, and all the incentives the government has already built right into the code. Which brings us to a final thought. In these high-stakes games, understanding the deep structure isn't just an advantage, it's everything. Thank you for watching.